It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start your morning. We have a tentative deal. President Biden and House Speaker Kevin McCarthy have struck an accord that would extend the U.S. debt limit for 2 years. It just needs to pass both chambers of Congress by June 5th, the much anticipated X date. The bipartisan deal, labeled as historic by Speaker McCarthy, caps spending for the next 2 years. The other key details: it will eliminate $1.4 billion in IRS funding. It ends the pause on student loan repayments and overhauls the National Environmental Policy Act. Now, this could expedite a natural gas pipeline backed by Senator Joe Manchin and will be seen as a big win for Republicans and a blow to climate activists. The bill's first test comes today as it faces the House Rules Committee, the gatekeeper of any legislation heading to the floor. And investors thinking this is a done deal, they still have a slew of headwinds to contend with, not the least of which the June FOMC meeting, which is now pricing in a quarter-point rate hike. U.S. data continues to tell two different stories here. Of course, services still hot, while manufacturing screaming recessionary alarm bells. There are two big data points ahead of that crucial meeting. The first comes this Friday with the May jobs report. We'll be looking for continued signs of resilience in the labor market. Plus, with prices still elevated, U.S. CPI the day before the meeting will more than set the tone. Last week, the Fed's preferred gauge showed the fights to contain price rises is far from over. And number three, the market's AI darling, it isn't done outperforming. NVIDIA is kicking off this week in the green after its $184 billion rally last week. The chipmaker is doubling down on generative AI with the unveiling of its new supercomputer at the Computex Forum in Taiwan. CEO Jensen Huang saying that the company has closed the digital divide. It unveiled a host of new products, including new robotics design and advertising services. A skeptical response from Cathie Wood amid the fervor, however. She says NVIDIA is priced ahead of the curve.
Well, we have a tentative deal. President Biden and House Speaker Kevin McCarthy have struck an accord that would extend the U.S. debt limit for 2 years. It just needs to pass both chambers of Congress by June 5th. Joining now, Max Cohen, Punchbowl News congressional reporter, and also with us is Michael Aroney, State Street Global Advisors, Spider Chief Investment Strategist. He'll be joining us for quite a little while here. But let's get to Max first, because as we know, this is not now a done deal. It is a tentative deal. Although I'm seeing quite a lot of optimism being expressed by the strategists whose notes I'm reading this morning, Max, that it is, in fact, going to get through. What still needs to happen?
Sure. So, as you mentioned in the opening, the House Rules Committee is a first hurdle. That bill needs to pass the committee, and there are 3 Republicans already on the committee who could tank this, and they've expressed some severe reservations with the bill. Those are conservative hardliners, Chip Roy, Thomas Massie, and Ralph Norman. But we expect that actually to pass the Rules Committee. Then it could go down to the House floor for a vote as soon as Wednesday. Then it goes on to the Senate. And with that Monday, June 5th X date, the Senate will have to pass that probably sometime late Sunday. So there are a number of hurdles, but I think that's probably an accurate read. Where we stand now, people are confident they can get through Congress and get to Biden's desk.
Historically here, Michael, too, when we think about how the markets have typically moved on any type of debt ceiling negotiations, how does this compare to previous instances that we've seen in the past?
I think what's interesting is that the market's been very calm in terms of their reaction. So headed into the negotiations, the VIX continues to remain low, one sign of volatility. Markets continue to do reasonably well. There was a high sensitivity in terms of each move. When it was going poorly early last week, markets were off. But as the deal took shape, markets really seemed to catch some fire or catch some a positive bid. Now, I think what's interesting is back in 2011, when Obama and Boehner negotiated a deal, most of the losses came after the deal was negotiated. So it'll be interesting to see this time around if we follow the same script.
And Max, in terms of what is in this agreement here, it doesn't seem like it is, when all is said and done, a huge cut to spending, right?
Well, over 6 years, if these spending caps are kept in place, it could lead to a $2 trillion cut in spending. When you consider the national deficit is much larger than that, I think you're right. In the grand scheme of things, it's not super significant. And keep in mind that estimate of $2 trillion over 6 years, that's assuming these spending caps are kept steady for 6 years, as you see in that graphic there. It's only 2 years that it has to be kept steady for. I think that's a good analysis in that, although some of people negotiating this wanted a huge transformational deal, this is in reality more of a limited deal, which might have come through the normal appropriations process in Congress.
Max, it seems interesting that it sounds like they have the votes lined up in terms of the markets at least reacting that way. That's the sentiment. I guess I'm more curious about, do they have enough time? And is June 5th really the X date? It seems to be a moving target.
Yeah, I think Congress people are very confident June 5th is the X date. Janet Yellen had said as early as June 1st for a while, and then she clarified late last week, said this will be June 5th. Members of Congress across both sides of the aisle are confident. I think that is legitimate. I do think they have time. One thing about Congress is when they have to move quickly, they do. And there is a very strict looming deadline, and they know they have to meet that. The key thing is the House passed it Wednesday. If that happens, move to the Senate. And the Senate might have some roadblocks with some senators objecting to a quick time agreement. But I do believe they will have enough time if all goes to plan. But again, it's Congress. You never know what might happen until it happens.
Max, there was a lot of, and continues to be a lot of political posturing, as there does anything that takes place within the Beltway. But for this specifically, how does this change the calculus if we're to think out to next year, into 2024, given that this is seen as a deal that largely favors some of the Republican talking points and the GOP talking points and initiatives that they'd like to move forward with, or at least curb where Democrats have campaigned in the past? So how does this change that calculus?
Great question. I think you look at President Biden, he's running for re-election. He wants to pivot to the center. In terms of his own futures, you could say this is a positive for him. He can go out the campaign trail next year and say, look, I worked across the aisle with the speaker and I cut spending. Maybe I put on work requirements. Maybe I did things which independents or Republican-leaning independents like. But for Democrats in the House, Democrats in the Senate, they are very frustrated. As you mentioned, they feel like they caved. So there's kind of an interesting dynamic here between maybe progressives, leftists in the Democratic caucus in the House and Senate who are more aggrieved, but Biden actually might feel pretty good. This shows his deal-making chops.
Michael, I want to get back to the market reaction for a little bit. Initially, there was some concern that since we didn't know what the spending cuts would be, it could have an economic effect. But now it doesn't, for most of the estimates I've seen, it's not going to be a big hit to economic growth. Is that reassuring as well for the market in addition to a deal potentially getting done? I
think it is, and I think partly the reason why the market suffered after Obama and Boehner negotiated their deal was sequestration and fiscal austerity. And
sequestration, I haven't heard that word in a while.
I'm pulling it going way back here on a Tuesday morning after a holiday. But I think from my perspective, I think that the economic impact isn't as great as feared. But I do think that the bigger takeaway continues to be this notion that if you believe that government spending in the last few years boosted economic growth and stoked inflation, then over the next few years, it'll at least be somewhat of a restraint. So investors should expect lower than what we would have gotten in terms of economic growth as it relates to government spending, and probably a little bit less inflation. Music to the ears of the Federal Reserve.
Yes.
And so further down that line, too, if you were an investor now thinking about what's the debt ceiling and where the different kind of spending allocation now moves forward, for investors who, to your point earlier, they've likely looked past much of this, thinking that there's going to get a deal that gets done. So now if you're thinking about going further out and looking at where the spending is, do you rotate at all now knowing where that funding is going into?
Potentially. Before the deal was negotiated, a lot of businesses that relied heavily on government contracts were underperforming the market. So I think they may get some relief depending on the details of the deal. I think the one continued area of strength is on the defense side of things. So both Democrats and Republicans agreed not to reduce defense spending, particularly given some of the geopolitical challenges. China's back in the news again this morning in terms of refusing a meeting between the two defense ministers. Again, depends on whose side you listen to, but certainly they can't seem to get on the same sideline here. And ultimately the Ukraine-Russia conflict. So it was interesting that both sides kept defense spending growing. And I think that those areas will likely continue to do reasonably well going forward.
Yeah, although there's some chatter that Lindsey Graham wanted more spending, but that's another matter. Max, we are also glad to hopefully put this behind us. I think safe to say. What's next in Washington? What do we have to worry about now? Or is summer going to be pretty quiet?
Well, summer might be quiet, but then we have fall and we have the government funding. They have to pass these 12 appropriations bills on time, or we could face an automatic continuing resolution. That's one of the aspects of this bill, which really puts a lot of pressure on the government appropriators to come to a budget deal, which has not been done in Washington for a very long time. We've operated on omnibus funding, on continuing resolutions, and they're hoping for a change to that with this new deal. So as we get into late summer and early fall, it's going to be government funding and maybe a shutdown. Who knows?
Max Cohen, Punchbowl News congressional reporter, and Michael Aroney from State Street Global Advisors. Thanks so much, Max, for joining us this morning. Michael's going to stay with us here for this next conversation as well. The debt ceiling drama may soon be behind us, but the good times keep rolling. Now onto the market's next hurdle. Pros are saying that it's a true toss-up if the Federal Reserve will hike rates again at its June 14th meeting, suggesting there could be more market movement ahead. The market currently sees around a 60% chance of another hike, but sentiment has fluctuated in recent weeks. The U.S. jobs report out Friday could tip the scales. Joining us now to discuss, we have Michael Aroney, State Street Global Advisors Chief Investment Strategist, and Callie Cox, eToro USA Investment Analyst, joins us now as well for this conversation. Michael and Callie, thanks for taking the time this morning. Callie, I'll go to you first. Even as you think about what this next potential Fed decision could hold for the markets and the volatility that could ensue, is it any different from volatility that we've already seen leading up to this point in the year?
Well, lately we haven't seen much volatility. So I think that's the funny part that everybody's trying to contend with. But no, I think as we approach the Fed meeting, a lot of the catalysts look to be the same. Inflation is still not under control, even though it's progressing in a nice direction. It's definitely progressing lower. The job market, by all indications, still seems to be strong. And that really is the equation for the Fed right now. The Fed is trying to balance inflation by hammering the job market, and by that equation, another hike may be on the way.
And what's really interesting to me about that, Michael, as somebody was pointing out on Twitter this morning, like the markets and the Fed just can't get on the same page, can they? Because the market still seems to be pricing in a cut before year end, even though the Fed has indicated pretty strongly that's not its base case at all. And the Fed commentary we've gotten recently is not clear that there's going to be a raise at the June meeting. Yet the market thinks there's going to be a raise. Like, what are the risks when they are not on the same page in that fashion?
So I think the risk is certainly disappointment. So what's really interesting about this, Julie, is that it's kind of ironic that if the Fed were to cut rates, typically the markets react negatively when they're cutting rates because they're cutting for a reason. We're either already in recession. So if you thought they were behind on inflation, will already be in recession when they start cutting rates, or there'll be something wrong in the capital markets. So that's not great for risk assets going forward. On the flip side, if they were going to kind of tighten rates, the market's not on the same page and they're not expecting that. So I don't think that that's particularly good for risk assets either. So I think what's really interesting is this purgatory, this limbo period's probably best in terms of from the last rate hike to the first rate cut. Risk assets can do okay, and that might be the environment we're currently in as the market seems to kind of teeter around 3,800 to 4,200. We've finally broken through that level on the S&P 500, but it's taken a while. And so I think that this kind of limbo period might be best for markets, because if they cut or tighten, I think both those scenarios could be a problem going forward.
Perhaps just for the sake of this conversation too, and in contextualizing what indicators people should remember to pay attention to and look for as the Fed is going to eventually pivot at some point, but the specific indicators that they're going to look at to actually determine whether or not they need to pivot.
So Brad, I think everyone must have been on vacation on Friday, or they were distracted by the debt ceiling, because I can't believe the market's reaction to the PCE, the core PCE. It showed an acceleration of inflation and the market didn't blink. And that was a bit surprising and a departure from what we had observed earlier in terms of some of the reactions to higher than expected inflation. So I think inflation is going to continue to be a key. Does it continue to come down towards the Fed's target? We know it won't get there this year, but directionally it needs to be headed that way. And then certainly this is a big week for the labor market, ADP, the jobs report. And I think the Fed continues to be equally confused by the fact that the labor market hasn't softened yet after all those rate hikes. And so I think that seeing some weakening, some softness there would be key to at least the Fed pivoting or stopping their rate hikes.
The market didn't blink on Friday in part because it was too taken aback by NVIDIA, perhaps. And I don't want to cannibalize our later conversation because we're going to talk about NVIDIA. But what I'm struck by once again this morning is the strength in, Callie, I'll take this one to you, the strength in the Nasdaq futures, right? In the face of, you know, if the debt ceiling thing is indeed resolved, you would think yields could be potentially moving higher. That wouldn't be good for tech, although yields aren't moving higher this morning. But like, how are you thinking about how all of this, and as it relates to big tech?
Yeah, so I think the way that tech has moved lately has really shown us that there are a lot of different flavors when it comes to technology. Obviously, there's a lot of hype around AI. I think some of the hype is warranted. And of course, we'll get into that in a few minutes probably. But you know, I think that investors are looking at tech in two very different ways. A, for its potential for, you know, future innovation, and that's where AI comes in. But on the other hand, you know, I think a lot of investors are looking at big tech towards safety, because everybody thinks of big tech as these high-flying growth companies, but they're really not that anymore. There's some of the companies on the stock market that have the strongest profit margins, the strongest cash hoards, the most durable balance sheets. And, you know, I think investors are kind of taking in stride as both. I am a little worried because, as you mentioned, you know, high yields are moving higher and the Nasdaq doesn't seem to be blinking. That seems a little out of step for me. But at the same time, I can understand why investors are looking at tech the way that they are. And I can also understand why it could seem really confusing because it's a sector that's in transition at the moment.
And so, Callie, even as you were talking about kind of the multiple flavors of tech, I wonder if there is a specific flavor within AI that is the most tasty for investors to perhaps kind of ponder at this point in time.
I think it's really too early to know which flavor could excel within AI because, of course, AI is a longer term story. I think everybody can agree on that, and it's in its very early stages. I mean, if you're thinking about how to invest in a longer term theme, I think you have to almost look at a basket of stocks because it is too early to tell who could be the market leader here. And it could very well be big tech. I mean, Google and Microsoft, of course, are pretty high up in the chase for AI at the moment. But at the same time, they have a lot of disruptors nipping at their heels. So, you know, right now, I think it's really, really tough to put all your eggs in one basket when it comes to one stock leading the AI race. Because if it is a long-term story, you know, these leaders are going to change, and you may be in the camp where you might just want to, you know, put a little money in each one instead of betting on one to win it all.
Well, hold that thought because we're going to talk more about AI right now. Michael and Callie, you both are staying with us. And let's bring it back to the stock I mentioned. That is NVIDIA. Guess what? It's up again, 4% after its $140 billion rally in a single session last week. The chipmaker's doubling down on generative AI. It now has unveiled its new supercomputer at the Computex Forum in Taiwan. NVIDIA's CEO Jensen Huang saying the company has, quote, closed the digital divide. Yahoo Finance's Dan Halley joins us now with the details. And Dan, I know this is technical stuff, which you are expert in. Break it down for us. What exactly is this new product that Wang talked about there?
Yeah, so essentially what they rolled out was the DGX GH200, and basically it's a supercomputer platform. Now it's made up of a number of graphics chips, 256 to be exact, of their GH200 super chips. And so what that essentially does is they previously had the DGX A100. This is apparently has 500 times the memory of a single one of their DGX A100 systems. And so this is essentially built for AI. It's a supercomputer. This is not necessarily something that every company is going to have, but hyperscalers will be into this. And I just want to point out some of the other features that they announced. One is a new kind of gaming technology. That's right, they still are a gaming company. It's called NVIDIA ACE, and this will bring generative AI to video games. So currently, if you're playing a large game and you talk to a non-player character, a computerized character, someone has to go in and write the code for that, write the dialogue for that. This is going to allow companies to basically use generative AI to get those characters to speak and have tons of different dialogue. So it'll be really, really interesting to see. They also announced that they're going ahead and have an agreement with WPP, the advertising giant. They're going to be working with NVIDIA to make sure that their partners get their hands on a new kind of development platform that allows them to basically put together advertisements using generative AI. So one of the examples was if there's a car ad, usually they have to fly out someone with the car and go through that whole rigmarole, or they'll do a Hollywood-style workshop where they'll go ahead and kind of put together the graphics for it. But in this, they'll be able to do it all from one single content platform. And so that's the pitch there, is that any company can get their hands on this and go ahead and make a ad without having to go through all the expenses. Now, obviously, there's the discussion of what does that mean for creatives, for all those jobs that then I guess would be eliminated as a result of this technology. But really, I think the conversation for NVIDIA here is how much further they can push this. And just to go over that supercomputer real quick, the hyperscalers that are already working with NVIDIA on this include Google Cloud, Facebook parent Meta, and Microsoft. So they're among the companies that are going to be getting access to that supercomputer, and that'll help them really drive their generative AI as well as general AI capabilities into the future.
Yahoo Finance's own Dan Halley with the latest there on NVIDIA. And for more on the future of artificial intelligence, let's bring back in Michael Aronis, State Street Global Advisors Chief Investment Strategist, and Callie Cox, who is the eToro USA investment analyst. We'll get back to Callie later on. But Michael, let's start this conversation just with perhaps the rising tide, at least of AI talk right now. Does that benefit everybody, or is it specific players that are going to be kind of netting out as the most beneficiary gainers in this?
So Brad, I think in the first stage of this, typically with any new innovation, any new disruption, kind of rising tides lifts all boats. So anything with AI in it tends to do pretty well, and I think that's what we're seeing. I think there'll be a next phase or a next stage where we start to weed out the winners and the losers, but I don't think that'll be for a little while. So I think you'll continue to see kind of anything with the AI, the generative AI label, continue to do pretty well here, at least for this year, probably in the first half of next year. And it won't be for a little bit until you start to see the wheat separated from the chaff or the winners separated from the losers. NVIDIA, though, clearly has a history of innovation on the gaming front. I remember, and I'll do this quickly, I had a neighbor come by and he said to me, hey, I'm graduating high school, I have to pick a stock for my high school project, and this was 2018. What would you suggest? And sometimes strategists get lucky too. I said, you should pick NVIDIA. I says, they're doing great stuff in gaming. I figured he'd like the video gaming stuff. Yeah. And he thanks me all the time for that. I think he won. And so here we are, 2023, and now they're on the next stage of innovation. So I wouldn't doubt them. I just think it's important in terms of, kind of price is what you pay, value is what you get. As an investor, I just get a little concerned when I see these big jumps. I think we're getting a little ahead of ourselves in terms of the opportunity, but that will begin to take shape.
I think he would say you're a good neighbor.
I was going to say, I hope he put real money in there, not just for the purpose of the context.
I did tell his dad, I said, I hope you put some of the college tuition in there, because that would have helped out.
I want to pick up on that last point about price, right? Because you're looking at NVIDIA potentially today hitting $1 trillion valuation. There's some reporting today that Cathie Wood said it's a little too rich for her blood, which is a fascinating call, given what's in her portfolio. But how, and I won't ask you about NVIDIA specifically, but I'm just curious, when you're talking about valuation, I mean, the potential for this stuff, the way you hear people talk about it, is almost limitless. Does that mean you should pay anything for it?
I don't think so. I think oftentimes we see that there's this big run-up in excitement and anticipation of future growth. And that future growth doesn't typically result in what's expected. And you see the disappointment. It's then typically, as an investor, when they disappoint and they don't live up to the hype, that's when you can really step in and buy some at a bargain or buy some of the winners from the losers and really make some money. At least for right now, if you want to get in the AI game, I'd have a diversified few investments that might benefit from the trend. Because as I said to Brad, I think they'll all go up, at least in a little bit here. And so I do think that AI, anything with the AI label, will continue to be positively viewed, but will definitely run ahead of what the business potential is, in my opinion.
Callie, would love to get your perspective on that too. When will, in terms of some of the investor attention that has rallied around or at least put a lot of mind share into the AI trade right now, when will that kind of prove it or lose it in terms of the investor attention moment really kind of prevail or happen in front of our eyes?
Yeah, well, first of all, I want Michael to be my neighbor. My neighbors to move out.
There is a wait list.
I know. Yeah, but when it comes to AI, I agree with everything Michael said here. I mean, right now we're in the hype stage. We're trying to understand how much of this is real. And when I think about, if AI can live up to that massive hype, I think about what it can do for the economy, how entrenched it could become into economic value. And for that, I look at productivity. And I think there's something striking that a lot of investors are missing at the moment. I mean, we've seen a lot of advancements in tech, in the 2010s over the past decade, but we haven't seen the appropriate gains in productivity to come along with it. When I talk about productivity, I mean economic output per hours worked. It actually is an economic data series that people measure. So, I think AI has a lot of potential, but for it to be like the second coming of the internet, or something that could, take hold like the internet did, I think we need to see gains in productivity. Otherwise, this could be, an exciting technological innovation that fizzles out a little bit earlier than one expected. So I'm a little skeptical, but I'm still very excited about the promise of AI. And I think investors should consider that when they're thinking about where to invest and how much to allocate to this theme.
I mean, to Callie's point, if it does live up to that promise, it might not just be good for these AI companies. It could be good for, just buy the SPX, buy the SPY, right? and just, benefit from that overall boost. I don't know. But it's hard to time all of that.
Yeah, it's interesting. One of the other things that was kind of note was that companies in the S&P 500, to your point, Julie, this earnings season, a record number of them mentioned AI.
Right.
And so I think it was more than 100 companies, and that blew away the figures from all the way back to 2010. Was a record number of mentions during earnings season. So certainly other industries have kind of caught on to this trend or are excited about it. And one of the things that really stood out to me was that when they broke it down by sector, of course technology's there, of course some of the other kind of communication services, but the other one was industrials. So to your point, they're trying to find a way, and to Callie's point, to bring up that productivity, to use AI more efficiently to either improve their growth or better manage their efficiency in terms of their operations. Either way is good as from an investor standpoint. So I thought that was really interesting data that I just kind of came across this morning.
Yeah, well, I guess time will tell whether it's like the other buzzwords that were mentioned a lot on conference calls, .com, blockchain, metaverse, or if it's going to be a more sustainable thing. We shall see. Callie, good to see you. Callie Cox is eToro USA investment analyst, and Michael Aroney, State Street Global Advisors chief investment strategist. Michael, you are going to stay with us. Coming up, SoFi shares are jumping in pre-market trading. We'll tell you why the stock is being considered a debt ceiling winner. That's on the other side of the break. We got the opening bell that just rang on Wall Street. Let's do a quick check of the market, sponsored by Flex Shares. And we see a mixed picture here, interestingly, to start us off here. We got the Nasdaq in the lead once again, up 1%. The S&P only up about half of that. And the Dow is very little change today. This is even as it looks like we're getting closer to a debt ceiling deal. That's something that everybody has been waiting for. Brad's over at the Wi-Fi Interactive looking at some of the early action here, Brad.
Yeah, absolutely. And kind of taking a broader look here as we are nearly rounding out the month of May. We've got today and tomorrow, of course, left. But taking a look at the Dow Jones Industrial Average here today, it's flat just barely to the downside. Keep a close eye on these past couple months that we've been watching here. And for the Dow Jones Industrial Average, for the Dow, as you would call it in your hood, we're going to look to see exactly where May ends out here, because that looking like it's going to be a down month following what we had seen during the month of April and some gains there. And then additionally during the month of March with some gains there that we saw. So ultimately might be looking to snap that streak. The Nasdaq Composite, though, as you're taking a look at that month to month, looking to add on to those gains. And year to date, we're up by about 25% on the Nasdaq Composite. Here today, up 0.9%. S&P 500, you're seeing that up 0.5% out of the gate this morning. Year to date, seeing gains of about 10% there. Also want to take a look at a few heat maps here. First, we'll take a look at the major sectors here for the S&P 500. 11 sectors, got them loaded up on the screen for you. And as of right now, out of the gate, real estate, that is leading the charge right now. That's up by about 1.4%. However, bringing up the caboose, you've got energy. That's down by about 1.3%. More gainers than laggards here. Also do want to take a brief look at some of those AI stocks as they are ripping here this morning, considering what has been announced over the course of last week with NVIDIA, and then even more of that momentum in the space really pushing many of those AI players into even more of those gains and this positive territory being held onto here, except for a handful of names, just about 4 of them, notably Google or Alphabet, Baidu, and then 2 others also joining in on those laggards. But taking a look at C3 AI, you're seeing them out of the gate higher by about 10%, 11% this morning.
Can you pull up NVIDIA real quick on there?
Yeah.
Why don't we look at a year-to-date chart, because NVIDIA is now at $1 trillion, drumroll, $1 trillion in market cap. It got there today with that 4% bump on the gains that it saw late last week. Bringing that year-to-date gain, what was that, 178%? For those shares, which is just incredible here. So again, $1 trillion is the market cap now for NVIDIA. It's only the 9th stock ever, Brad, to reach that level. There are some of the other more recent entrants there to have reached that size of market cap, which is pretty extraordinary.
Yeah, really interesting to also see some of the other players that have been having quite the year within this broader landscape, the AI landscape here. Perhaps I'll just toggle back over to the Nasdaq Composite where we can get a good look at those $1 trillion market cap companies. Amazon, actually, you're seeing 2 of them in the bottom left-hand corner here, with Alphabet and Amazon also being in those throws. And then additionally here, I had to kind of adjust my screen there for a hot second, but NVIDIA is definitely within that $1 trillion market cap landscape. And 177% year-to-date gains for NVIDIA. Now, of course, this context after the decline that we had seen during 2022 with some of the larger tech players out there. But NVIDIA last year took an L. This year, maybe the bounce back continues. We'll continue to watch that. Yeah,
why don't you pull it out to a 5-year? Because I think it's there and then some compared to where it was pre-pandemic, given those losses. Yep, there it is. That makes sense, obviously. It wasn't at $1 trillion before, and it's at $1 trillion now. So we're looking at a record stock price and a record market cap there for those NVIDIA shares after it said, Jensen Huang, the CEO, saying that basically we're going to see a whole replacement cycle for the types of chips that are in data centers now, and then rolling out that additional products at Computex in Taiwan. So really interesting stuff.
Absolutely. And I mean, as we were talking about with Michael a moment ago, the amount of mentions of AI over the course of this earnings season for S&P 500 companies far exceeding what the records were before. And even as investors start to think about where those plays within AI are, you probably had the best example over the course of the Meta earnings call, where Mark Zuckerberg laid out that you're going to have applications that sit on top of language learning models. And then at the base and the core of that is the the chips. And so those chip players really having an outsized move here with the AI mentions and where they're seeing some of that revenue opportunity move forward.
Definitely. Well, we're going to keep an eye on NVIDIA, of course, and the broader move in AI, but want to get to some other potential opportunities for investors. Michael Aroney is still with us, State Street Global Advisors Chief Investment Strategist. As we talked about a little bit earlier, stuff like NVIDIA is pricey. We might continue to see the overall AI universe go up. But in the break, we were also talking about some areas maybe investors weren't paying as much attention to that might provide some opportunities right now. And you were saying maybe people should look outside the U.S.
So I think that is something that we are talking to clients about and investors for the second half of the year. And so I think it's interesting. I think that international stocks like Europe and Japan have underperformed the U.S. for a decade. And as a result, they're cheaper, but that's not enough of a reason to buy them. They're always cheaper. There's structural reasons why they're cheaper. I had a client joke with me and says, every year someone comes around in January with a British accent and tells me to buy Europe because it's cheap, right? And that's not a reason to buy. So what are the reasons? Interestingly enough, there's two. There may be more than two, but there's two that stand out. The first is over the last 3 quarters of the earnings season, revenue growth and earnings per share growth, and the magnitude of which those companies are beating in MSCI EFA stocks, for example, is far better than the US. So now all of a sudden that 30% discount that I'm getting on a price to earnings basis, on a valuation basis, becomes a lot more interesting. And then the second component of this is that we expect that the dollar will soften some as the Fed ends its tightening cycle. So naturally it rises when the Fed's tightening rates, but when they stop, the dollar usually falls over. Now, just quickly, last year, we know the UK shot itself in the foot. Japan's holding on tightly to yield curve control. Everyone was worried about Europe and the Ukraine-Russia war and the potential winter energy crisis. And of course, the China issues in terms of common prosperity and zero COVID. All of those have started to kind of come back a little bit, and the dollar's down about 10% or so from its highs. So as a US-based investor, that acts as a tailwind. So I think it's the combination of those three things that makes international investing. And then just quickly, Japan just hit a 33-year high, I think just yesterday. So it continues to do quite well.
Well, that's been one of Warren Buffett's favorite new entry points over the course of this year. I mean, last year was all about Oxy. This year seems to be more about where he sees some of the growth opportunities within Japan. Why do you think that is?
Well, it doesn't surprise me as, Warren Buffett as the value investor, right? There's a picture of him next to value investing, maybe in the dictionary, although that probably ages me some, Brad. But I think the view here is that if I look at and you just showed the chart, the market, a lot of the Nasdaq stuff hides a lot of the underlying narrowness. So it's only 5 or so companies that have really resulted in that 25% year-to-date gain. And the breadth in the market just hasn't been very good. So if I think about this just quickly, not to be too wonky, but if the S&P is trading at 19 times forward earnings, and I take the inverse of that, the earnings yield's about 5%. Well, you, Julie, and I can buy a money market fund right now that yields 5%, so why take the equity risk? But international stocks like Japan trade at 10 or 11 times their earnings. So the earnings yield on that is closer to 9%. And therefore, there's a bit of a cushion, and as value investors like that cushion. So it doesn't surprise me that Warren Buffett sees that as a value opportunity, given some of the valuation dynamics from U.S. stocks to international.
Now, all of the international stuff you've been talking about thus far is developed markets. It's not emerging markets. Are emerging markets then less attractive?
So we're more neutral in our positioning right now in emerging markets. Now, we were underweight, so we're more neutral to our benchmark, about a 10% allocation to the equity. That's about what their weight is in the global benchmarks. So the challenge, Julie, is that they should benefit from lower inflation, they should benefit from a weaker dollar, and they should benefit from the fact that the Fed is likely to end, whether it's in June or kind of this summer, they're likely to end their tightening cycle soon. So that's all a benefit. The challenge is that their earnings and revenue growth just hasn't been as good. The estimates have been falling, and therefore the same kind of valuation dynamics just aren't as attractive right now, keeping a close eye on it.
Michael Aroney, State Street Global Advisors Chief Investment Strategist, who's been joining us throughout the morning. Thanks so much, Michael. We appreciate it.
Thank you.
Absolutely. Well, let's switch gears here. We got to talk about some of the movers that we're tracking this morning. Shares of SoFi, they're jumping, as Destiny's Child would say, up by about 7.8% right now, early this Tuesday morning. The fintech company, they're saying that, well, the fintech company that actually offers private student loans and refinancing, they're benefiting from President Biden's and House Speaker McCarthy's debt ceiling tentative deal, which would reinstate student loan payments and the accrual of interest later on this summer. This was one of the names that's been called out within the street. BTIG had commentary that put out a few of those notable winners as well this morning.
Yeah, so this has been such an overhang for SoFi, right? Because this keeps getting pushed back and back and back. And the real key for SoFi is when the refinancing of student debt, that cycle really begins anew. The shares are up 8% this morning, but something caught my eye that same note from BTIG said, we remain unconvinced that there will be a tidal wave of refi activity in the student loan space. That's because of the move, they say, in interest rates and a perception in the market that moving to a private loan could mean missing out on any future government beneficence. I can't even say that word. But the point is, the Supreme Court is considering this as well. The Biden administration then might propose legislation on this. So there's still some uncertainty surrounding this and whether there might be future legislative or executive debt relief of some kind.
Yeah, essentially saying within that note, the student loan saga continues as they were kind of rounding out their assessment there. There were a couple of notable winners that they said. I believe Intuit was in there, or at least within that conversation.
Yeah, and H&R Block as well.
Block, so and defense names too. It was interesting to see, especially now that we've got a little bit more of a signaling of where funds will be reallocated or cut in some instances. Defense certainly comes into the throes of those conversations as BTIG was reviewing that.
Yeah, it's interesting that we're not seeing that much move in HR Block and Intuit, I believe, but the idea there being that the IRS funding that's set to get a huge increase is now being cut back a little bit. So does that mean potentially less competition for those tax preparation services? And then one more name I want to mention that BTIG highlighted is Equitrans Midstream. This is the developer of the Mountain Valley Pipeline, because as part of this deal, there is possible expediting the approval of that pipeline. Yeah, 42%, a little tidy gain there for Equitrans. So we'll keep on watching that one as well. And another stock we're watching is Coinbase. Those shares are up 10% after Atlantic Equities upgraded the stock from neutral to overweight. The analyst behind that call says, quote, while risks remain in the form of a weak volume backdrop, the company's first quarter results confirmed management's focus on returning the business to sustainable profitability, and those shares are getting an 11% bump here this morning. Yeah,
the firm talking about Coinbase and within this price target that they maintained of $70, which still would be like a 23% move higher from the close that we saw on Friday of last week. They said risks remain in the form of a weak volume backdrop, recession, regulation, and market prices, but they believe that Coinbase's recent actions allow investors to look through towards the longer term opportunity there, and saying that those actions are building resilience in the business model. And we've talked about a lot of the different levers that Coinbase has tried to pull, whether that is anything to drum up in a crypto ice age, as some have called it, how they can drum up even more accounts, more signups, more net users, and even within that, where they could have a place within staking and the entire kind of framework around that, especially with some of the newer upgrades to blockchains, has changed as well in proof of work versus kind of proof of staking. But then additionally, even within those businesses, you're also thinking about Coinbase and how they're offering storage. The storage mindset has changed entirely as well, given not just some of the crypto hacks that have taken place, but how people just want to be comfortable with the crypto that they have amassed and ensuring that it's not at risk by sitting in a hot storage and instead trying to move that into a cold storage wallet.
Yeah, I mean, the other interesting thing here is that Atlantic Equities analyst says that this is basically the best expression of crypto, in his words. Bitcoin today isn't doing much, so it's interesting to see Coinbase up this much. So it's obviously not a perfect proxy, but interesting that he made that comment as well.
Absolutely. Also, everyone, coming up on the other side of this short break, the market breathing a tentative sign of relief over an agreement on the debt ceiling, but there are other risk events ahead. Yahoo Finance's Jared Blickery back at the New York Stock Exchange. That's next. Welcome back, everyone. Let's get to Yahoo Finance's Jared Blickery over at the New York Stock Exchange there on the floor of Wall Street. Jared, what's popping?
Well, I'll tell you what's not popping is the Hang Seng. Now, I want to do a little bit of an instructive look at what's happening over in China so that maybe there are some lessons here for the US. And of course, I'm trying to get the Wi-Fi interactive now, but it is not cooperating. Nevertheless, if I were to pull up a chart of the Hang Seng over, let's say year to date, you would say, okay, it's down 20% now. I'm reading all these headlines this morning. So Hang Seng enters a bear market. Well, I'm scratching my head. I thought we were already in a bear market because if you pull up a 3-year chart, you can clearly see from the top about early 2021 or whatever, it was a straight shot down to get 55, 60% down from those highs. And so now it's still 40% down from those highs, and yet everybody was talking about a bull market in it, at least this year for a while until yesterday, or at least until this morning. All of this just to show that these things, these definitions that we go by are very much just arbitrary a lot of times. You take a look at the Nikkei, what we were talking about, it's at a 33-year high. We have markets going in opposite directions all over the place here, lots of disconnects. And I gotta tell you guys, if you take a look at the bond market, and I'm looking at the 10-year T-note yield in particular, it's down about 7-8 basis points today. That has been on fire recently, so a little bit of a reprieve here. And let me see, it looks like I might have the Wi-Fi interactive, tentatively speaking, but so we have a little bit of a reprieve from the surging yields. We have a little bit of a reprieve from the surging dollar. Nevertheless, guess what, guys? We have seen the market very much resilient, and despite these moves, which would be counterintuitively supporting anything like the growth trade, that is exactly what's happened. So we have a market that is edging up, that is surging in terms of tech stocks on any good news. We also have the rest of the market trying to find its footing, bunch of sector rotation going on, bunch of pain trades going on, and then we have the debt ceiling. You pile that on top of everything, plus a Fed meeting in 2 weeks, there's a lot that can go wrong here. So I think it's a little bit early to get ahead of ourselves and say, okay, this is gonna be like early 2021 when every buying strategy on earth goes up. It's just not the case anymore. So we need to be a little bit more defensive, a little bit more selective, and also not ignore the prevailing trends in that one sector, in that one area of the market, which is just absolutely on fire now, which is AI. However, if you're playing this on a speculative basis, you better have your stops, because this is a market that turns on a dime.
It is indeed. Across a number of assets, I was watching oil, for example, and its declines today. So a lot to choose from. Jared Blickery, thank you so much. Great overview of what we are seeing here. Coming up, a big week for economic data kicks off with consumer confidence from the Conference Board. We will have those numbers coming up, and another look at the market in a moment. Let's get to some trending tickers for you from the Yahoo Finance homepage. NVIDIA, number one, and it's probably not even close here in today's session. The stock is up about 6%, and as we've been talking about, has now reached $1 trillion. It is the first chip maker to get to that size of a valuation. It's only the 9th company to ever do so, as we have seen just this monster rally in the shares year to date, up 182%. But it's not just NVIDIA today that is trending. Basically, as we were just hearing Michael Aroney talk about from State Street, anything that has to do with AI, we are seeing that rising tide lift many boats. Tesla's on the list today. I guess it's sort of AI related, but also Elon Musk is visiting China. That might be a bit of a spur for the stock. Palantir, which is, I guess, seen by some as an AI play to some degree. Those shares are up nearly 7%. And then C3 AI, obviously that stock has seen a big rally this year. It's up another 15%. One stock that is not participating today, AMD, interestingly enough, those shares are down 1.5%. Perhaps as it being seen that it has to do a little bit of catch up in the AI arena. And then there's another sort of AI related story that I want to talk about, and that has to do with Cathie Wood of ARK Invest, who said, who lightened up on, actually removed NVIDIA from her portfolio, the benchmark portfolio, earlier this year before the bulk of this latest surge. And she reportedly making some comments that it was getting a little ahead of itself in terms of valuation and in terms of price action. So here's the existing ARK portfolio here, obviously without having benefited from that. And if we can take a quick check on the year to date here and how these various stocks have done, certainly there have been some big winners. DraftKings has doubled this year, Coinbase a winner as well, Tesla up 62%. But that big 180% or so gain from NVIDIA missing from this equation, Brad.
Yeah, really going to be banking on the Tesla AI dojo, I suppose, within the ARK fund. Everyone, coming up on the other side of this short break, from big earnings to those made jobs numbers, we've got a lot on tap this week. We'll tell you what to expect next. All right, welcome back to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Markets here this morning as we are 30 minutes into trade to start off this, the final, well, not the final trading day of May, but we've got one more after this. Anyway, taking a look at the major averages. We're mixed right now. Dow flat, just barely to the downside. S&P 500, that is green in positive territory by about 0.3%. Nasdaq Composite up by about 0.6% right now. We've also got some breaking news this morning for that. Let's get on over to Julie.
Yeah, it's summer, baby. We got summer brain. Apparently, consumers do too, because consumer confidence from the Conference Board coming in higher than estimated, 102.3 versus the 99 that economists were looking for. And guess what? There was a higher revision for April as well, up to 103.7. So we saw a decline month over month, but not a large one. A lot of this coming from the present situation versus expectations. Present situation, 148.6. Those expectations not so hot at 71.5. But nonetheless, this showing a decent amount of confidence. Now remember, probably more so the University of Michigan confidence, but also Conference Board, just measures of consumer confidence generally. One of the things that has been feeding into the Federal Reserve and their direction on rates, not just inflation itself, but how consumers are feeling, because it maybe has some implications for their willingness to continue to spend, and therefore the ability of inflation to keep on trucking, as it were. So this is definitely an interesting number, and one that maybe will give even more fuel to some of those rate hike bets for the meeting in 2 weeks' time.
Yeah, hot dollar summer, perhaps, among some consumers out there. As Kevin Hart would say, you got a pocket full of ones, somebody go and get them. All right, guys, for more on the tap for this week and May jobs data as well, investors got a lot to digest this week. Yahoo Finance's Josh Schaefer is here to give you a look ahead. Josh.
Yeah, Brad, so a lot going on this week in a shortened week, but I want to start with the earnings first because I'm excited to hear more about the AI trade, and I think everyone is. And when you take a look at the earnings this week, we actually are going to get a fair amount of commentary on artificial intelligence, I would expect. You see Salesforce on that list coming up on, that would be Thursday. Wednesday, sorry. I'm bad at days with the shortened week, right? But you have Salesforce tomorrow, Broadcom on Thursday. Also curious what we hear from C3 AI. We've talked about it a lot. That's a company that has obviously soared this year, shares up about 200% as we've seen this AI boom. But the company last quarter did revenue of about $66 million. So it's not that big of a company yet. And I'm curious how the market reacts to a company like that clearly has been a momentum trade. But what do they actually want to hear from executives, and sort of where are people going to maybe start to take gains off the table, right? When we think about some of these companies that have really boosted over the last week, basically on the back of NVIDIA, and how does that sort of happen and react once we see those calls? I'll be curious to see.
I don't know. We got the Sazi Hyman trade later in the week with Lululemon. I always pay a lot of attention to that to see what the higher end consumer, if they're.
I just want to see if my pants are on sale.
That's what you guys are both saying. The same thing. Exactly. Hard pants. We're all wearing them, unfortunately. But let's talk about the economic data this week as well. Obviously, the jobs report is the big one on Friday.
Yeah, I think the jobs report is really what we're looking for here on Friday. And an interesting number to watch is always that non-farm payrolls number, and specifically if it hits 200,000. So right now, consensus estimates on Bloomberg are a little bit shy of that at 193. I should note that's up from when I normally write our weekly look-ahead article on Friday, but up to 193 now. But 200,000 is going to be an interesting number to watch for me, guys, because several banks out, analysts, economists, saying that 200,000 number could be, if there are more than 200,000 non-farm payrolls, that is more likely for a Fed rate hike. Just they're circling that as sort of the line in the sand. Anything above 200,000 is, all right, the job market is still a little bit too hot. Yeah. Also, that unemployment rate, does that stay historically low? Remember that 3.4% was the lowest number we've seen since 1969. So if that number stays very low, you get the non-farm payrolls up, we might be talking about a June Fed rate hike, maybe even a July Fed rate hike. Citi said that this morning. Citi economists out this morning saying 200,000, if that hits, they are in line for a June Fed rate hike and a July Fed rate hike, which should be very interesting.
That's the first time I've heard that.
Yeah. All right, Citi with the cold water out this morning. Thanks so much, Josh Schaefer, encapsulating all of what we're going to be watching for this week. And for more on what to expect in the week ahead, we're joined by Bill Adams, Comerica Bank Chief Economist. Bill, great to have you here this morning. You know, we've got an abbreviated trading week. However, still, as Josh was laying out, a bevy of economic data plus some earnings reports that are coming forward that will really give us a signal of where consumers both kind of the end consumer sitting at home or the business consumption as well, where that's continuing to stand right now. What most notably would you be paying attention to over the course of this week?
I think the big releases this week are obviously that jobs report on Friday. But the other one is going to be the survey of manufacturing purchasing managers. That's the people who are buying the inputs to manufacturing businesses coming out this week. And that is a really great survey for measuring price pressures in the business to business part of the economy. We have seen inflation moderating there from where it was in 2022, but in the last couple of months, it's sort of treaded water at relatively high levels. So I'm going to be watching that report to see whether the prices component of that survey points to further moderation in inflation.
It doesn't, I mean, the PCE was not terribly encouraging, was it, Bill, that we got last Friday? One of our earlier guests pointed out that the market kind of shrugged it off here. Is there just this belief that we are going to see deceleration in inflation gains? And, you know, it seems like the data is not necessarily supporting that.
Yeah, there's a conflict between the data in hand from the PCE or the CPI out earlier in the month versus what you get from business surveys or from consumer surveys, where you do see a little more progress on inflation coming down. And the catalysts of high inflation in 2021 and 2022 also seem like they should not be as much of a problem going forward. You do see a little bit more softness in the labor market in some of those business and consumer surveys, like in the Conference Board survey out this morning. If you look at the balance of consumers who say that jobs are plentiful versus consumers saying that jobs are hard to get, the labor market still looks solid, but it does not look as strong as it did earlier this year, and it looks considerably less tight than it did 6 or 12 months ago. And that is going to feed into less wage growth over time, which not as good for wage earners, but good for inflation in services prices, where the cost of labor is a big input to what businesses have to pay to provide those services to consumers.
If we did see more than 200,000 jobs get added, does that automatically, as Citi was pointing out, or at least expects, does that automatically mean that we see potentially 2 more rate hikes?
I think the Fed is more concerned about inflation than the labor market right now. And I think the data they're watching more closely are those inflation data. We're going to get another CPI report out immediately before the Fed's June decision. And I think an upside surprise in that report will probably nudge the Fed toward another 0.25 percentage point rate hike. But I think more likely than not, they're probably still on hold in June. With that said, it's a close call. But I think the decision is really going to be more determined by the inflation reports again than by the jobs report. The Fed knows that the labor market's tight. I think the June, the release of the May jobs report at the end of the week is likely to still show that even with job growth a little faster, a little slower, the unemployment rate around a half-century low points to a tight labor market.
Bill, we haven't talked about the debt ceiling yet, I think in part because we're all too happy to put the thing behind us. But, I mean, when all is said and done, was it a non-event?
It looks like the debt ceiling is getting closer to resolution, where not everything's done yet. Chair Yellen said that she thinks the Treasury has about 5 or 10 days before they run out of cash. Now, historically, the Treasury has a couple of other tricks up their sleeves where they can extend that deadline. But it does look like we're set to get a deal. I think that's going to result in federal government expenditures growing a little slower than inflation in 2024, which should contribute to a softer economy overall, slower growth, and helping to bring inflation down. So I think it's resolving basically, if you'd asked me 12 months ago to guess what the 2023 debt ceiling deal would look like, I'd say something like this. It does seem to be resolving close to expectations.
Okay. And so, yeah, as that is finally perhaps coming to a close here, the attention, of course, shifts back to, and really has always been on the Fed over the course of this year, but the debt ceiling at least giving Fed Chair Jay Powell a second to go sit by the pool for a moment at least. But now, if we go into the tenor of what these talks continue to hold within the Fed, Is there anything that we should be watching for to say on the other side of this that they could see reason to cut?
I think the Fed definitely is monitoring downside risk to the economy from, increased tensions in the financial system. For example, credit spreads have widened over the last 2 months, 3 months. I think they are monitoring the effect of high interest rates on the economy and on the real estate market. But right now, the Fed, it's important to remember the Fed doesn't have a GDP growth mandate. They don't have an economic growth mandate. They have a maximum employment mandate. And so with the unemployment rate so low, the Fed really is just still focused on inflation, and inflation is too high. And I think their decision about when to stop with rate hikes is really going to be determined by inflation slowing or maybe continuing to surprise to the upside. I don't think that's likely, but it's still possible. And I think with that the case, the Fed's rate cuts is at least a quarter or two away. And if the economy kind of ekes out a soft landing this year and the labor market stays very tight, I think we could be looking at interest rates above 5% on the Fed funds rate into 2024.
Well, we'll be watching to see if that's the case, but luckily we have some inflation data heading our way before the Fed's next meeting. To your point, that interesting on the manufacturers purchasing survey this week. We'll keep an eye on that, and then CPI. Bill Adams, Comerica Bank Chief Economist, thank you.
Thanks for having me.
And let's take a look at one trending ticker we're watching today. Shares of ChargePoint are on the rise, almost 13% after the company got an upgrade from Bank of America from neutral to buy. The analysts are saying the EV charging company, quote, has proof of execution and is a best-in-class way to play the EV charging field. ChargePoint hit an all-time low earlier this month, but Bank of America says the company is set up to weather recessionary pressures. We shall see. Coming up, one analyst says SoftBank's ARM could be the next big AI play, but is the pop in it too early, perhaps? We'll talk about it next. quick check of the markets now, sponsored by Flex Shares. We've seen the markets give up a decent amount of their gains here. The Nasdaq, which out of the gate was up better than 1%, now has cut that just about in half. The S&P also has cut its gains in half. The Dow down about 0.1%. We've got that consumer confidence data coming in stronger than estimated. We also have a big slump in oil prices today, down about 4%. That's affecting the Dow in particular because it's has more oil stocks in it, or weighting-wise does. The XLE, the energy ETF, down about 1.5% today.
Well, AI hype is dominating the markets. Shares of SoftBank and NVIDIA popping today on news that they are collaborating on a generative AI platform. And our next guest says this could be the next big play in AI. We have Atul Goyal, who is the Jefferies managing director here. Walk us through the thesis here, why this is the next perhaps big push that we're set to see, especially from a company in NVIDIA that has absolutely been making headlines and continuing to hold on to mindshare both among some of their corporate partners, but in the market as a whole within this broader thrust towards AI.
Thanks for having me, Brad. I want to make a distinction here very clearly that it's two different companies, SoftBank Corp, which actually announced a partnership with NVIDIA, and SoftBank Group. So SoftBank Corp did not rise yesterday. SoftBank Group went up 8%. The partnership is actually between SoftBank Corp and NVIDIA. On the other hand, a few years back, NVIDIA was trying to acquire ARM, if you remember. That was from SoftBank, and they gave up the deal. That angle is still somewhat valid. Now, SoftBank Group is trying to get ARM listed later this year. And while most of their product and sales are towards mobile phone devices, a certain part is for data centers where they compete with Intel. And that's the part they are likely to highlight and dress up as an AI play for data centers. So essentially, it's a dress up. Heading into the listing, we expect SoftBank stock to do well. But going up too fast, too soon is something that we are a little worried right now. The IPO is still several months away.
And so do you buy their dressing up of ARM as this AI play? And I mean, I know, you're not covering yet the IPO because the company hasn't come public yet. But is that something investors should be looking at?
So, Julie, thanks for that. There are some companies that we believe are investments. So you invest. You build a position, you might trade in and out a little bit, small positions, but you invest. And then there are other stocks which you trade actively. SoftBank Group, in our view, is more of a trading stock, which you trade in and out. There are opportunities it gives you to short, and there are opportunities it gives you to go long at times. Currently, it's trading very close to our fair price. In late November, when it went to 7,000, it was too far high. We downgraded to sell. And once it closed to our target price, we upgraded to hold. Now, we are waiting for the stock to catch the AI hype into the ARM. And there we expect the stock to rally significantly. For every $10 billion of ARM valuation increase, SoftBank stock could rally about 15%. So we value that at around $40 billion currently. But if in a hype, ARM gets revalued much higher, it will give an opportunity at that time to trade SoftBank at a higher level. However, history suggests, and this has been twice the case, SoftBank was the biggest owner of Alibaba in 2013. It was 2014, sorry. When it got listed, that was the day SoftBank stock peaked. And for many months and many years after that, it did not touch that same stock price. Same thing happened with Uber. So the risk is going into the ARM IPO, the stock rallies a lot, but after that, it collapses. So that is what we are mindful of going into that hype. Does it make sense?
Yeah, certainly. And so as we think about some of the biggest beneficiaries that have at least seen their own stock move as a result of the AI hype, if that hype starts to settle and we start to see revenue be prioritized among investors, as we should, and that reattachment to the fundamentals of the business as well, in tandem with some of the demand that they are seeing or at least forecasting, are there three big names that you expect to outperform, given that we've heard that chip companies are kind of that foundation of the broader totem pole, if you will, for AI?
So globally, our firm's view, Jefferies' view is essentially that on the back of this investment, you're likely to see semi-cap equipment manufacturers like AMAT, like Lam Research, Tokyo Electron, ASML benefit. Because besides the chase for AI-driven, the AI hype, you also have a massive amount of support that the governments in US and Japan and Europe are giving to these chip manufacturers to establish capacity outside of China and outside of Taiwan. And as they do that, all that money is going to go into building up equipment capacity. So the likelihood is that these companies, other companies like AMAT, ASML, Lam Research, and Tokyo Electron could also benefit immensely as the cycle begins from here onwards. So they're already off their lows, but going next 3 to 5 years, these companies could also benefit immensely.
Atul, I wanted to ask you sort of a broader question, because we have seen such an incredible climb in the Japanese market more broadly. That hasn't been true necessarily of these large cap Japanese tech stocks that you cover. In the case of SoftBank, for example, it hasn't done the same thing as the market. But I'm just curious how you're thinking about that with all the enthusiasm that there has been as of late in Japanese markets.
I'm really glad, Julie, you touched upon that one. It's something very unique that is happening in Japan. And it's not just about Japan creating a new high after 30 years. That's a side story. The real story is something else. And I, for long, while I've covered Japan stocks almost 20 years, I've been a Japan skeptic. I believe there are few good companies, great companies, and you invest in them, stay long. However, we are at a juncture where a lot of push is happening in Japan, where there is possibility of naming and shaming if the companies do not do the right things. So collectively, thousands of companies are going in the right direction to improve the return on equity. And to do that, they have to do certain things in a right manner, collectively. I've not seen this kind of movement in 2 decades. And this is genuinely for the first time. So there would be some tourist investors which will come. Japan does very well once every 3, 4, 5 years. That's always the case. But this is something more, something deeper. And what you're saying about the breadth of the market, which is very narrow in US, the breadth of the market in Japan is extremely wide. This is something really important that's happening in Japan. And I'm not sure if it's being encapsulated in the right manner, except for highlighting that, yes, it's creating new highs in the indices.
But you're making it sound like this is a real, more profound turning point, and that if what you're saying is the case, then that would mean that those highs could perhaps be extended in the broad market there.
See, this is again a 30-year-old index high that we reached. That's not important. Across the board, I mean, I do believe over the next 1 to 2 years, we'll see new and new highs. The amount of money that's coming into Japan, the amount of interest that is coming into Japan is something that I've not seen for a long time. And this time for real, it's for genuine reason. If the company's return on equity goes up, if the companies are willing to divest non-core assets, generate cash. Look, I cover a company which, it's an investment. Sony is my top pick. Even that company, while it's winning in multiple places, they recently announced they will be exiting Sony Financial Holdings. That's a non-core insurance business. They are spinning that off. So a company that's done very well, if over the last, let's say, 6, 7, 8 years, the stock is up about 7 times. It's done very well for shareholders. Its ROE is above 15% consistently. And yet they are doing the right thing. So it's not just 1 or 2 companies or 10 companies that are under pressure. Collectively, Japan Inc. is doing a phenomenal job. And again, not enough investors are paying attention. They're only looking at the index. There is a very widespread movement that is happening. And this is something quite remarkable. I've never seen something as important because in Japan, the carrot doesn't work that well. And this stick of naming and shaming and downgrading some of the companies from the prime section to the standard section is actually working.
Atul Goyal, who is the Jefferies Managing Director. Really great insights and analysis there. Appreciate the conversation this morning. Thanks.
Thank you, Brad. Thank you, Julie.
Certainly. Coming up, Comerica Bank is facing serious allegations around its handling of veteran and Social Security benefits. Get the details next. Comerica Bank has been the financial agent behind the Treasury Department's Direct Express program, distributing monthly benefit payments to about 4.5 million veterans and Social Security recipients since 2008. Now it's facing a series of class action lawsuits over alleged mishandling of fraudulent transactions. Joining us now is one of the reporters following the situation, Kate Berry, American Banker reporter. Kate, thanks for taking the time here with us this morning. So help us kind of just set the scene and lay out the story. What are some of the allegations that have come forward?
So some of the allegations have to do with the way Comerica and its vendor dealt with data on these Social Security's veterans and disability recipients. The Comerica outsourced the operation of the program to two vendors. One of the vendors had shared data and was doing fraud disputes out of an office in Lahore, Pakistan, which goes against the contract with Treasury. The contract with Treasury says they have to operate within the United States. And Comerica executives knew this and had internal documents talking about the serious violations of the contract, but that they didn't have the ability to do anything about it.
Why not? Why wouldn't they have the ability to do anything about it?
That's a good question. I think part of this has to do with oversight of third-party contractors, what oversight that there is, and how the government can see what they're doing. If a company is operating outside of the United States, bank examiners don't have a lot of insight into what they're doing. So that's really one of the issues outstanding.
What is, I guess, kind of further in the issues outstanding, what is wrong about the way that perhaps they were contracting or at least working with this international partner overseas, and in the request, where was the violation of the service level agreement or the agreements more generally, that they had been kind of acting on for years?
So there have been problems with the program, mostly as it relates to fraud. So these are very vulnerable Americans, veterans, Social Security recipients, disability recipients who do not have a bank account. And Treasury created the program, Direct Express, to wean people off paper checks. So they get their monthly benefits on a prepaid card. And prepaid cards do have a problem with fraud. And the bank and the vendors knew that there was a problem with fraud. But what happens is the bank is really required to follow certain laws. And it's unclear whether they were relaying that to the vendor and whether the vendor was actually treating customers in the way that they should be treated.
Kate, I'm curious the genesis of this in the first place. In other words, understanding that this is a breach of contract, but why are these vendors required to operate in the U.S.?
Well, that's a requirement for Treasury contracts. I don't know that I can answer that. I think it's really because the federal government expects its contractors to operate in the United States. I think what you have here is a bank being required to conduct oversight, and whether that oversight is actually happening. And again, this is a very vulnerable population of people who don't have bank accounts. So what would happen is people thought these were bank accounts and would have $30,000, $10,000 in their accounts. And when fraud hit, the account was completely wiped out of any money. And when they called the vendor to say their account was hit by fraud, the vendor would not necessarily tell them what they could do about it or if they would be reimbursed for the money. And some were not actually reimbursed. So I think it's unclear how many people this affected and what kind of data the bank actually had to determine how many people were affected.
Wow, so that's the scope then of this problem potentially. Kate, thanks for breaking it down for us, and thanks for the scoop. Kate Berry, American Banker reporter. Appreciate it.
Thank you.
Coming up, AI's energy use could be a problem. Why one chip maker thinks they have a solution. That's next. Could the AI arms race spark a new energy crisis? According to MIT, AI consumes more energy than traditional computing, with a single model's training burning more electricity in a year than 100 U.S. homes. Joining us now, Renee James, Ampere Computing CEO. Renee, thanks so much for being here. And you guys, in full transparency up top, you guys make more energy efficient chips. But let's talk first of all about the scope of the issue, right? Because data centers, even existing without this full AI capability, they burn a lot of energy. Is the industry sort of doing enough to address that?
Thank you, first of all, for having me on to talk about something that, of course, is near and dear to Ampere, because we were founded on the principle of building sustainable compute, putting aside the demands of AI. 30% of the data centers in the world, which really power the cloud growth that we are all experiencing, are in the United States, and they already use 2% of all of our energy. And so when we founded the company 5 years ago, we said, look, my team and I had been building microprocessors for a long time and felt that it was time for us to build something that could deliver more power, more performance with low power. And that's really the thesis of the company. High efficiency, sustainable microprocessors to fuel the cloud growth, which is only going to be accelerated even further with the use of AI. That's what we're about.
Certainly. And so kind of further along what your business, what your company is doing to make sure that we are advancing artificial intelligence to the event that, or to the extent that demand is continuing to come forward, but in a more sustainable and environmentally conscious way. How many of the customers that you speak with are prioritizing their environmentally or sustainable practices as they move towards AI versus just looking for better cost as they're looking to get into this next wave of technology?
I think that's a great question. The good news is that the cost factors into sustainability, because one of the great drivers of cost, of course, is your power bill. So the more sustainable the compute solution, the lower the overall total cost of ownership, because it brings down, of course, power and cooling. So our customers consider this to be quite important. It's one of the primary calculations that they look at. Every single data center operator knows that the grid has told them that they can't guarantee more power, or they're asking them to offload power. So it's a real-time situation. As they think about adding AI, which only requires 20 plus X on some kinds of these queries, these searches, if you will, they have to find even more sustainable solutions. So we talk in our industry about a term that, normal people who don't do this for a living are like, what are these people talking about? Which is called dense computing, which is getting better utilization out of the existing data center that you've already built with the existing power that you're already using. So if you were able to use a more efficient microprocessor, more efficient per, if you will, server rack inside a data center, then you more tightly, densely packed, you get a better utilization. And that's really what the thesis of Ampere is about, but it is now playing more broadly into the ESG goals of our customers. And I believe the demands that users are going to want long-term about the ability to sustain our growth.
Now, Renee, you guys are a private company, so I don't know how much you can tell me. But what can you tell me about demand for the chips thus far? I mean, when we hear NVIDIA talking about the exponential gains in demand we have seen, what are you guys seeing?
We are private, and I will just say thank you for asking. Some of us know we're on registration. We are excited for the market to open for new growth companies at some point in the future. It's been good. I think we have a bright outlook on that. Look, when I lived through a couple of different phases of compute, and when the PC first hit its stride when I was new to the industry, the thing that really fueled it, there's always some big new use of computing that fuels that growth phase. Our current phase is cloud and AI in the cloud. At that time it was media. And in the beginning, we had to have special purpose a bunch of new hardware to be able to create videos, if you will. And the thing the PC could do is play it back very efficiently. So when I think about AI, I think about the same way. You're going to have to build, accelerated compute, modules to be able to train the AI models. That's absolutely accurate. That's something that NVIDIA does very well. But there's a growth in the AI, if you will, inference, which is kind of, if you think about it like media, it's like playback. It's the thing that's in your browser. It's the thing that's in every one of your applications that assists the app. That should be done most efficiently on the regular processor in the computer. And so from our perspective, building sustainable and low power, super high performance computing, which, the history of our industry and microprocessors has been use power as a proxy for performance. So higher power gives you higher performance. What we're pioneering is lower power and high performance, not low power, low performance, which has been kind of the history of low power. And that, we think, will allow data center operators and hyperscale cloud operators to efficiently deploy artificial intelligence into everything, into all their services. And that's really the exciting part about our company, and our thesis of sustainability has become even more relevant over the course of the last 5 years.
And Renee, just quickly here, how should people think about what your chips replace? In other words, it sounds like NVIDIA is not a direct competitor. Who would be your direct competitors?
Yeah, I mean, what we're really looking for is the growth of the cloud for data processing and for inference processing. And we think about the traditional CPU companies that really have lived in that space for the last couple of 40 years or so, like Intel and AMD. NVIDIA is a great partner of ours, and they are doing accelerated compute and very exciting things. And I'm really, I'm always happy for someone who's doing well, because this business is so difficult. And, certainly NVIDIA has been after it for 30 years. So it's exciting for them.
Renee, even prior to the latest wave of focus around AI and chips and how they play a role within generative AI and other uses, there's still the larger geopolitical overhang around chips right now. How much of that is continuing to be a factor in where AI can have its next leg of growth?
Yeah, I think, for the traditional compute part of the business, that thankfully has not been a tremendous overhang for us. I do think for the predominance of the long-term AI, we'll be able to do, the non-training portion, and a lot of the general purpose use of it will be able to be done on processors that are not currently subject to export constraint. I don't know. I think there's a lot of discussion going on. There's a lot more to be discovered about what we should and shouldn't do. It's always difficult. In the beginning of a new phase of computing, this always happens. We're not clear on, what are the things that we should hold tight or we should deploy widely. And I think we're going through those discussions right now with the Commerce Department.
Renee, really fascinating conversation here today, and we appreciate the time. Renee James, who is the Ampere Computing CEO. Thanks so much.
Thank you.
Absolutely. Coming up, what happened to the grand reopening? The China story takes a twist to the downside, with the key index falling into a bear market. So is the only way up from here? We're going to discuss that next.
Tesla shares are higher this morning as CEO Elon Musk meets with China's foreign minister in his first trip to the nation in 3 years. His trip happens to coincide with that of Jamie Dimon. He's back in the nation for the first time since 2019 for JP Morgan's China Summit. And the visit by two greatly influential U.S. business leaders is all the more noteworthy as it comes at a time of stasis for U.S.-China relations. Then there's the economy. A key index in Hong Kong briefly slipped into bear market territory this morning. The move notable considering investor expectations around the big reopening for the world's second biggest economy. Investor pessimism has really taken hold, down to a toxic cocktail of geopolitical tensions, a weak yuan, a COVID resurgence, and weakening economic data. Joining us now for a deeper dive into China's economic outlook is Shahzad Qazi, who is China Beige Book International Managing Director. Thanks for being here. This really sort of struck us today, Shahzad, as we see Elon Musk and Jamie Dimon in China at the same time, for example, that China has rebuffed a U.S. offer for the two defense chiefs to meet. So what do you make of these sort of two tracks, if you will?
Yeah, I mean, these two tracks are telling you, conditions there are today, which is that on the political side, there's still ongoing tension, despite the fact that the Biden administration is now trying to really calm down some of the controversy surrounding its export order restrictions. It's also being unable to work through its outbound investment executive order, which should, in theory, actually give markets some pause for calm. But we're not seeing that play out. I think you're getting a lot of tension because in markets because of the geopolitical ongoing crisis, if you will. On the other hand, corporates are doing what they're supposed to do. They're trying to look out for their bottom line and work around the two nations as they continue to compete with each other.
We heard at the outset of this year, and great to see you, Shahzad, that the IMF and kind of the broader forecasts were that China and India would really lead growth over the course of this year in 2023 for international GDP as a whole. Where do we stand within some of those targets, and are we off base of some of those projections?
The expectations at the beginning of the year were wildly unrealistic, especially as far as China is concerned. And not just the IMF, which kind of just parrots what I think a lot of other research suggests. But, a lot of the Wall Street research that was coming out was suggesting that, as soon as COVID-0 would be over, you would get this surge in economic activity. And we were publicly pushing back on that pretty aggressively. That was wildly unrealistic. Q2, although, was a much more realistic time to expect signs of a recovery. And if you look at China Beige Book data that have come out in May, there are signs of consumer spending strengthening. There are signs of manufacturing actually holding on and doing better than was expected by anybody. So I think economic data may be on the cusp of turning right when markets have just completely soured on the Chinese economy.
Well, that sounds like a good buying opportunity if you're looking at, if that's correct, and we're looking at that kind of formula. So what can we expect then going forward for the second half of the year out of the China economy?
I think June data are going to be critical. We have to see over the summer if consumers continue to spend and if we get this robust recovery of sorts on the consumer spending side. I think property markets, and if you're a commodities trader, don't hold your breath. It's going to be a mixed picture through the rest of the year. Manufacturing, I think we get some headwinds building up there because of slowing Western demand. Signs of that already in the latest CPV numbers that have come out. So all around, not that bombastic picture that a lot of folks were promising at the beginning of the year, but I think conditions will be better than some believe today.
One of the interesting parts of this, too, over the course of this year is the relationship between China and companies, some of the largest entities within the region. Look no further than Alibaba and its announcement and now move to not just split up into 6 units, but also have one of those units go public and perhaps other pieces of that company that have been split up go public. All of that to say, are there other entities that you believe China could be looking at for similar activity where there is this type of split up that is either forced or at least discussed and then comes about?
Yeah, I think the process is not as clean, and I think some of those things become hard to predict. Alibaba was unique in how big it's gotten. If anything, other companies have probably taken that as a lesson. specifically as a lesson in what parts of the economy and what sectors to stay out of, and certainly to keep your mouth shut on policy matters.
Yeah, yeah, indeed. Thanks so much. Shahzad Qazi, China Beige Book International Managing Director here. Shahzad, great to see you this morning. Thanks for taking some time. One big issue from retailers this past quarter, theft, commonly referred to as shrink. Companies like Walmart, Ulta, and Dollar Tree, they noted an uptick in cutting into their bottom line here. Now, in a recent earnings call, Target's CEO said that the company could lose more than $500 million this year to shrink. And organized retail crime is becoming a bigger issue. Over the past few weeks, we've spoken with guests about the rising rates of theft in retail and what that means for the industry. Take a listen.
We're seeing a lot of retailers talking about increased shrink. Now, there are some things that retailers can do about shrink. So, for example, you can see them put more items, behind fixturing where, essentially you have to call someone over to open up the item. That's not great from a customer experience perspective. That can certainly work. You might see them, add, security guards into the stores. Dollar Tree was talking about in Family Dollar, they might even selectively raise prices in areas with high shrink. But to some extent, it's very limited in terms of what you can do.
Unfortunately, it's been worse than expected. So as we look ahead, the plan is for more labor as well as working on fixture. And this was a big charge at Target. It was $500 million. It also led to impact of Ulta's SG&A op margin. So the impact is very real. What really needs to happen is collaboration across the government, companies, society, products. A collaboration likely needs to happen. I don't think there's an easy solution to this, and it continues to evolve, but unfortunately it's gotten worse, and it's been quite material in terms of the margins and what stores have to do, largely in terms of investing in additional labor.
To be clear, this is a problem for all retailers, but our main focus at Walmart is protecting our associates, protecting our customers, but also protecting our merchandise. But this is not an issue that one retailer or either the retailers at large can solve by themselves. We need engagement from the local communities to help solve this.
The unfortunate answer is yes. I think figuring out order of magnitude and where it hits worst and who has already told us about it versus not. But shrink is absolutely something that unfortunately I think we all have to account for and consider and hopefully can be fixed.
It's impacting a lot of retailers at present. Target does have mitigation efforts in place. They're working with local law enforcement. They're working with the NRF and RELA, so national retail organizations, and with other retailers as well to help to mitigate the effect. They're also adding in more shelf security in stores to help impact the overall shrink issue. Is it going to disappear tomorrow? No, but it's an issue that over time should lessen as these initiatives hopefully tend to bear fruit and mitigate the overall issue that Target's facing from a shrink standpoint.
Let's do a quick check of the markets, sponsored by Flex Shares. Major averages in the U.S. are mixed right now, nearly 90 minutes into trade. The Dow Jones Industrial Average down 0.4%. S&P 500 and the Nasdaq, though, in positive territory. The S&P 500 is up by about 0.2%. The Nasdaq Composite up 0.7%.
And coming up, a shift in Tesla's advertising model. Rochelle Akufo will speak with an expert next on that big change. You don't want to miss that. And we're going to be back tomorrow. Have a great day, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. We have a tentative deal. President Biden and House Speaker Kevin McCarthy strike an accord that would extend the U.S. debt limit for 2 years. The bill's first test comes today, with key votes expected tomorrow. We're across that unfolding story. And investors thinking this is a done deal still have a slew of headwinds to contend with, not least the June FOMC meeting and May's jobs report out Friday. We look at the risk events still on the docket, even if a debt default is avoided. And where's your port in a storm? A fresh report says 38% of US adults have no emergency savings. That's up from 34% the year prior. We speak with the AARP on tips to keep cash on hand in a difficult time. Well, first, let's check in on how the major indices are faring. Looking at a mixed picture here, we're seeing the Dow here under pressure, down about 120 points, as we still don't have really a clear view of what's next with this debt deal. And we're seeing Visa under pressure there on the Dow. Taking a look at the S&P 500, it's still in just barely positive territory. They're up about 6 points. We're seeing tech driving those gains up, and energy, the weakest performing sector in the S&P. Taking a look at the Nasdaq, which is being buoyed here, up 0.6% or about 80 points. Big tech lifting the Nasdaq, especially Nvidia and Tesla right now. Let's also check in on the Treasury market as well. We're seeing something of a flight to safety here as we see the short-term yield here down about 2.3%. Similar situation for the 10-year, down about 2.4%. The longer-term 30-year yields there, down about 1.3%. Well, President Joe Biden and House Speaker Kevin McCarthy have reached an agreement to raise the U.S. debt limit and avoid default. But now the bipartisan deal that neither party wanted heads to Washington, D.C. for congressional approval. Yahoo Finance senior reporter Jennifer Schonberger is here with the details. Hi, Jennifer.
Good morning, Rochelle. That's right. Congress is back today in what will be a critical week for both parties. President Biden and House Speaker Kevin McCarthy will face a test to see whether they have enough votes for a deal to raise the nation's borrowing limit before June 5th, when the government is expected to begin running low on cash to meet its obligations. In a deal neither side wanted, Biden and McCarthy spent much of the holiday weekend pitching their parties on it. House conservatives say the spending cards aren't deep enough, while progressive Democrats say the president gave up too much and aren't happy about stronger work requirements for food stamps. Democratic Representative Pramila Jayapal, chairwoman of the House Progressive Caucus, signaled over the weekend that getting support from her caucus, which includes 100 members, could be tough. Biden said Monday that he had been calling Democratic lawmakers to ask for the support and that there was, quote, no reason it couldn't get passed by June 5th, though as of Monday afternoon, the president had not spoken with Jayapal. Now, this deal would raise the nation's borrowing limit for 2 years past the 2024 election in exchange for keeping non-defense spending roughly flat in 2024 and increasing it by 1% in 2025. It also increases military spending by just over 3% and raises the age for work requirements to qualify for food assistance. Now, the bill will face its first legislative hurdle this afternoon when the House Rules Committee, which serves as the gateway to the House floor for legislation, will meet to review the deal at 3 p.m. Two hardliners on the committee, Representatives Ralph Norman and Chip Roy, say they will oppose the deal, with another conservative member, Tom Massey, also a possible no. If all three of those Republicans, in conjunction with Democrats, end up voting no, that could actually prevent the bill from getting to the House floor, though House Speaker McCarthy said Monday he doesn't expect that to happen. He does expect it to pass. If it does pass, that sets up a vote sometime on Wednesday, likely Wednesday evening, for the full House to consider the bill. Rochelle?
Certainly time is ticking. We appreciate that update, Jennifer Schonberger, there for us.
Thank you.
We're taking a look at U.S. markets, optimistic on high hopes that President Biden and House Speaker Kevin McCarthy's debt ceiling deal will get through a divided Congress before the dreaded X deadline. But despite a tentative deal, investors remain uncertain about the overall health of the economy. For more on the markets, we're joined by Neil Sharp, Director of Strategy and Content at Edison Group. Thank you for joining me this morning. So I first really want to get your gauge of what markets are really trying to digest at the moment and how much of this optimism is perhaps overly priced in.
I think there's still a healthy degree of caution in the markets, particularly around the US market. Concerns that no one's really confident around the outcome. So does the US avoid a recession, or do we see a hard landing? That is going to be sort of drawn out over the second half of this year. And I think there's a reticence to deploy capital while that is out there. So I'm seeing quite a lot of caution from investors about moving into new names. I think, growth is a premium right now, and I think that is being reflected in some of the large cap tech names doing well. I think liquidity is important. You've got to be able to get in and out of stocks. So again, the large cap names doing reasonably well, but it's notable that the US indices have underperformed the European indices, and I think the US is in a very different place to Europe right now. The concerns around growth are growing.
And you mentioned the comparisons with Europe, that the US market's underperforming versus Europe and some parts of Asia as well. Talk about the dynamics in play and perhaps how people can see opportunities in this.
Yeah, I think that Europe's surprised to the upside. A lot of markets are around expectations. So if you set yourself some low expectations, you could see some upward surprise to that. There were genuine concerns about Europe's dependence on fuel prices from Russia, et cetera. And I think those have eased as energy prices are coming down. I think the European economy and the outlook for the European economy is slightly more robust. We seem to be in a very different place to the US, where I think the rate rising cycle is probably coming to an end. There's more concern about whether you actually move into a deflationary cycle in the US, whereas in Europe, there's still scope for a little bit more tightening. The growth numbers are coming through, and it's telling us that investors are looking for growth over and above, the cost of capital here. European companies have done reasonably well in terms of the last reporting cycle, and they're at more attractive valuations than their US peers, and that's drawing investor interest in the region. So if you look at the year-to-date numbers, S&P, up a couple of percent. Europe is up nearly 12%, and that's drawing some attention. You're seeing a similar picture in some of the Asian markets. It's mixed, but Japan's done really well. I think this is I was listening to your previous guests in terms of caution around China, but there is expectation that Japan will be a beneficiary as China reopens, as the Chinese consumer strengthens. And again, the valuations of a lot of those Japanese companies are relatively cheap. So it's attracting investor interest. So I think the hedge is, you're moving into value names to protect yourself from downside risk. You're looking for growth, and Europe and pockets of Asia are drawing investor interest.
So then as we look at China, we look at the CSI 300, which is essentially an indicator of China's stock market performance, similarly to how we view the S&P 500. It did enter a bear market, though. Do you expect perhaps the S&P to follow suit, or what will perhaps be the difference, what will make or break whether or not the S&P follows that sort of suit?
Well, look, I think, if I look at valuations for the broader US market, you're looking at sort of PE multiples of around 15 to 18 times forward-looking earnings. And if you're moving into a sort of zero growth environment, I would expect those numbers, to attract people back into the market. You probably need to be at sort of 12 times. And so there is, to me, there's a sense of those valuations need to adjust downwards. Now, the one thing we know about the US market, it's a pretty dynamic place. And, there's a lot of people who believe that actually we're not going to see a recession in the US, and that it will work itself through the next 6 months, and actually growth will surprise to the upside. The problem is that we just don't know right now. So there is caution. I think the market's looking for evidence one way or the other, and to get conviction that we're heading in one direction. And if I was managing money today, I would be holding fire, because I think there's some great stocks out there. My sense is that you might be able to pick them up a little bit cheaper later on in the year, because I'm anticipating some market volatility as this debate takes place.
So Neil, are we talking sort of more interest in commodities, or what aspects would you be looking at as you're looking at some of your picks?
So typically, I mean, the sectors I think that are going to continue attracting interest, I think you've seen it already. The large cap tech names are doing well. I think over time, particularly as the rate cycle starts to flatten out, those names that can grow, which will be in those growth sectors, will start to attract interest again. The other areas that I think are starting to gain a lot of interest are the cyclical. So inevitably, as you move into a recessionary environment and these stocks get beaten up, the first things that give you outperformance are the cyclical names, because inevitably you'll come out of that cycle. So there's a lot of work being done in terms of which are the high quality industrial names, which are the high quality cyclical names. I don't think people are deploying capital to them right now, but I think they're getting ready to put them in, but put money to work later on in the year. My sense right now is that it's to a certain extent it's where we were sort of 6 months ago, that if you're building a long-term portfolio for 4 or 5 years worth of outperformance, the stocks that you need to ride out the near-term cycle is going to be very different to the stocks that you want to have in that portfolio over a longer-term trajectory. And hence, I think it's actually quite hard work, allocating money to names, which is why we're in the market we're in right now, which is it seems a little bit directionless. It's waiting for something to catalyze that change, and I think we'll see that play out over the next 3 months.
We'll certainly be keeping track of that. Neil Shah from Edison Group, thank you so much for joining me this morning.
Pleasure.
Well, while Asia's indexes are trading slightly higher this morning, China's economy appears to be stalling as investors' concerns mount over the country's coronavirus recovery. Chinese stocks in Hong Kong are flirting in bear market territory on Tuesday. The weakening yuan and growing geopolitical tensions are keeping investors away from trading overseas. The Hang Seng China Enterprises Index, one of the most followed Asian indexes, is more than 6% this year. Industrials production and property sales also contributing to the country's slowing growth as well. But despite China's weakening recovery and rising geopolitical tensions, business elites are flocking to the world's second biggest economy. Elon Musk arrived in China Tuesday morning to visit Tesla's Shanghai plant and meet with government officials on the country's electric vehicle industry. And Jamie Dimon is set to arrive in China on Wednesday for JP Morgan's China Summit. Now, where the CEO will weigh in on the bank's business outlook, so there'll be lots to watch there as well. Right, taking a look at Palantir shares surging today as AI hype dominates the markets. You see they're up almost 10% on the day. Now, the company has been climbing since reporting unprecedented demand for its AI platforms in Q1. The stock also getting a boost from ARK Invest's Cathie Wood, buying about $4 million in shares on May 22nd. You can see shares of other AI stocks jumping as well. Nvidia up over 5% today, and C3 AI up over 16%. All right, coming up, how you can build your best emergency fund. We'll speak with AARP's executive editor to get his top tips next. Let's do a quick check of the markets sponsored by Flex Shares. Still looking at a mixed picture here. The Dow here, though, bouncing around some of the lows of the day, off about 0.5% or 170 points. The S&P 500 there, still seeing just slightly positive gains here, just barely, not even a point up there, about half a point, in fact. And the tech-heavy Nasdaq there, strongest driver so far. We're seeing up about 0.5% there. Microsoft and Google under pressure, but the rest of big tech seeing some gains. Well, over a year of inflation has taken a toll on the average American and their rainy day fund as well. 38% of US adults reported they have no emergency savings. That's up from 34% the year prior, according to a recent AARP survey. Now, most experts suggest keeping enough cash on hand to cover 3 to 6 months worth of living expenses. Now, that's a daunting goal for those who've seen their savings dip. Joining us now with tips to how to improve your saving status is George Manus, Executive Director at AARP, the magazine. Thank you so much for joining us this morning. So, as we've seen this number of people who don't have enough to cover their emergency savings continuing to rise, what are your top tips then for building or rebuilding your emergency fund, especially if you've had to dip into it?
Well, the top tip, if I would condense all of my tips into one top tip, which is automate, automate, automate. The easiest way to build an emergency fund is slow and steady. And instead of having sort of to make the decision to put your money in a fund, week by week by week, you do it once. It's easy to get your bank to transfer money to a separate account, and it should be in a separate account. It could be $5 a week. It could be $25 a month. Whatever it is, just get started little by little. Every little bit helps. And so that's really the top suggestion is automate, automate, automate. And really, again, don't be daunted. Don't be intimidated by when somebody like us tells you it's great to have 3 or 6 or even 9 months of money in an emergency fund. Longest journey begins with the smallest steps, and you should start with that. So that's your first thing. Automate, automate, automate. Put your money into a separate account where you are not tempted to dip into it for everyday expenses. The second thing that's really important. Sorry, Rochelle?
Oh, no, please continue. You had your top tip there. I want to hear your second one as well.
The second one is then you got to do the tough work if you don't think that you have enough to spare. And in fact, our survey found that 61% of people said what was preventing them from adding to an emergency fund was the high cost of everyday living expenses. And no surprise over the past few years that's a situation given inflation. The next thing you got to do is you got to really look at your expenses on every day, like open up your credit card bill. You probably have a lot of standing charges there that you maybe even forget that you're paying for every month. You can go through and you can say, well, I got the subscription to this streaming service, this streaming service, this streaming service, and this one. Maybe I can cut back on 1 or 2 of them. So that's one thing to do is really comb your expenses, especially the ones that are on autopilot, and see how you can cut them back. The next thing you can do is try to figure out ways to find more money. And that, of course, is the side gig. And you don't have to print up business cards. It might even be as simple as looking in your basement and saying, boy, I got a lot of stuff in here. Maybe I could sell it on, Craigslist. I'm not recommending any particular site, but maybe you can sell it and get rid of all the stuff that is gathering dust in your basement.
So, George, I do want to ask you, because for some people, they're not actually sure sort of where to track where their money is going. For people who want to get a baseline of what they actually need versus perhaps so they can figure out where they can trim, what do you recommend in terms of finding out your baseline for what your essentials are so that you can figure out when to trim?
Well, that's a good question, Rochelle. What you really need to do is when you know your essentials by, for example, by looking at the stuff that you've had to pay. So it's just as simple sometimes as sitting down with a paper and pencil, pull up your bank statement, pull up your credit card statement. You know that there are expenses you have every month. The big three, you got to start with shelter, food, and health. So you go through there and you say, well, I know I got to spend this on rent and I have to spend this on my utilities. Then you go to food and you say, how much of my food is food that I purchase at the grocery store? How much of it is stuff where I get home from work late, I'm tired, and I do takeout, those getting home late and getting tired and not having anything around the house and doing takeout, that adds up over time. So really, you have the evidence in your hand. It's not like you need an expert to come and tell you this is where to cut back. You have the knowledge in your hands where you can look at your bank statement, you can look at your credit card statement, and you can look at your Venmo and what you're paying your friends for, and you can say, once you actually sit down and take maybe 3 months of bills or 3 months of statements and add them all together, no one's going to have to tell you where to cut back. You'll know.
And so then in terms of factoring in things like stock market volatility, if you're looking at your investments or inflation as well, how should people be viewing that when they're trying to make regular contributions, but they keep seeing certain things ticking up?
Well, for that, and especially if you're younger, the time is really on your side. You have to, sort of have a bifurcated view of life. You have to think about, okay, what do I need this month? What are my needs right now? And stock market, and either way, whether you're looking at short term or long term, what the stock market is doing at that moment shouldn't be affecting your decisions. So for the short term, you say, okay, I need this amount of money and this is the basics to get me through. For the long term, what you need is to take the long view, to realize that, as important as what's going on, let's say right now with the debt ceiling and everything like that, I think 20 or 30 years from now, as you're closer to retirement, or 10 years from now, even 5 years from now, you're going to kind of look back on this moment and say, well, that was a blip. Remember 2008, 2009, we all thought the world was coming to an end. And look where we are now. Anybody who took money out of the market and didn't put it back in is not doing as well as that person who really took the long view. So you can't let the short-term movement of the market distract you from either your day-to-day issues or your long-term goals. And one of the places that, we like to recommend for where to get advice about planning both for the short term and for the long term for your security and retirement, where we're suggesting you go is, shockingly to us, go to aarp.org/money. And we have years and years of information and knowledge and collected wisdom of all our journalists with really great advice about how to deal with both short-term crises and also planning for the long-term and your long-term financial security.
And George, just very quickly, because I know that when we talk about inflation and the stock market impact, we did see it was the 30 to 49-year-olds who really saw a significant sort of change in how they were saving and whether they were saving or not. But overall, though, in the study that you guys did, it did show that people were more optimistic than not over the next 12 months. If you could just quickly tell us, what do you think is driving that optimism?
It could be like human nature. And I think, and this is just a wild guess, but it could be, we went through the pandemic and that was awful. And it feels, although COVID is still an issue, we are not locked down. People are going traveling this summer. People are saying, okay, between, the people who do have money and the people who do see a little bit of daylight and the people who haven't been taking vacations because where are they going to go? And I think just maybe it's even just the summer coming. You're just feeling great and you just got to get out there and you got to go places.
Well, I do appreciate you joining us with those great tips and all that insight. George Manis there, Executive Director at AARP, the magazine. Thank you for your time this morning.
Thank you, Rochelle.
All right, coming up, following a big travel weekend, what can consumers anticipate for the rest of the summer? We'll share our interview with the CEO of TripAdvisor next. With Memorial Day travel now in the rearview mirror, people are looking ahead to summer travel. Akiko Fujita and Shauna Smith spoke with the CEO of TripAdvisor on Friday to gauge his thoughts on what to expect. Take a listen.
Americans are traveling again, and summer travel's back. We can see it in the airports, we can see it on the roads, and that's going to be true. The peak season is off to a great start. So it's going to be one of the best weekends in almost 2 decades. Some travel intent beyond Memorial Day is significantly higher than last year. And the vast majority of travelers are planning to take summer trips this summer, and they're even willing to spend more. Now, it doesn't mean that they're not going to be subject to some of the economic whims. They may make choices about staying closer to home. They may choose to drive rather than fly. But in the end, travel is back, and we're going to feel it this Memorial Day.
Yeah, so let's talk about some of those trade-offs that we're seeing, Matt, because it is fascinating to see, even in the face of higher prices. In the case of airfare, we're talking much higher prices. Travelers are still willing to pay the money there. So as they plan out their vacations, what's the trade down that we're seeing?
We're not seeing a trade down. We're seeing perhaps the choice to go somewhere closer to home, maybe do a slightly shorter trip, and maybe, again, think very carefully about where you want to spend. But the truth is that we have seen over the last year, and it's continuing, a shift from material goods to experiences, travel being one of the most defended discretionary spend in anybody's budget. And while Americans still have good financial savings in their accounts, they are prioritizing travel like never before.
Matt, when it comes to some of those pricing trends that you are seeing, let's start domestically. Are we starting to see some of those pricing pressures ease?
Well, look, I think pricing is always an interesting one to watch. Supply and demand is important. It's important to think about, what consumers want and what they're willing to go into. I think that you will see a pricing ease in some areas, but I think you will also see a new normal of pricing where, pricing came up and now it's moderating and staying where it is. So, as long as the consumer keeps spending, as long as there's demand, price will hold. There are ways to take advantage. When we think about how we try to serve the consumer at TripAdvisor, there's always options to meet every budget, whether it's where you're choosing to stay, how you're choosing to get there, or the kind of experience that you want to have.
And Matt, you're talking about some of the options being for Americans to stay closer to home, but we've also seen strength on the international side of things, with a lot of countries, especially in Asia, really opening up significantly over the last several months. What are you seeing on that front? And the thing that we keep hearing over and over about passport delays, how is that complicating those travel plans?
Yeah, international travel is clearly back. Share of international travel intent is returning to pre-pandemic levels in the US and EMEA. And of course, APAC has opened up and we're seeing intent to travel there at more than double than last summer, for example. So, travelers are willing to spend, they're willing to go far away. They're looking for experiences that are in far-flung places and going to really enhance their lives and make memories. I think the passport situation is something that, many of us in the industry have lobbied government to make sure that we are freeing up, the visa situation, getting passports out there so that people can travel unobstructed. And I think you'll continue to see international be a category of travel that will be hot through the summer.
Matt, this weekend certainly going to be an early test here for some of those airlines that have struggled to keep up with demand, especially when we take into account what happened last summer. How big of a factor, how big of an issue do you see labor shortage being this time around?
Well, look, everybody's talking about how they've staffed up. We know that labor shortages last year were a real sort of weight on the system. I think many of the providers have learned their lessons. I just traveled actually twice this week, once internationally and once domestically. And, it was easy and smooth. I traveled last night from New York to Boston, where I'm sitting today. And I can tell you, it really feels like in the airports, they have geared up and they're ready to take on the demand that's coming this weekend.
That was Matt Goldberg there, TripAdvisor CEO, speaking with Yahoo Finance's Akiko Fujita and Shauna Smith. All right, let's get to Yahoo Finance's Jared Blickery now at the Wi-Fi Interactive for today's top movers. Hey, Jared.
Hey there. Well, we just saw Europe close a few minutes ago, so let's take account of that. Frankfurt, the DAX down about 1/3%. In Paris, the CAC 40 down 1.5%. And in London, the FTSE down a pretty similar amount there. In the U.S., guess what? This is par for the course for 2023. The Dow is in the red, the Nasdaq is in the green, and that has been the story. And let's take a look inside the market here. At the sector action, you can see a split board. Tech, XLK, that is by far and away the leader. That's up 1.2%, followed by real estate, communication services, and consumer discretionary. To the downside, energy, the value, whether you want to call it value or defensive, that is taking the biggest hit, down 1.5%. Concerns over OPEC, maybe not cutting production over the next month. We'll find out over the coming days. But then staples, materials, healthcare, financials, industrials, rounding out the bottom. And let's just take a look at some of our leaders and our sentiment indicators. At the top, guess what? Baito, that is from last Friday, we're seeing some decent gains in crypto. K-Web, the Chinese internet, that is down 3.5%. And let's take a quick look at, that's ARK. Let's take a quick look inside China. And we can see China has become its own animal this year, has not for the most part participated in a lot of the uprun in the semiconductors and software. But here's the semiconductor situation right here in the US. NVIDIA up to $1 trillion. We've been talking about that. Another 5%. AVGO, Broadcom up 6%. And you can see not an entirely green board, but that just goes to show you there are winners in AI and there are losers in AI. And right now, only the perceived winners are getting that money flow. Here's software, a little bit less green, although Snowflake is up about about 5%. That is a notable standout. And I'll just leave you on some meme stocks here. Kind of a split board, but interesting to see GameStop and Palantir creeping up there, guys.
I see Coinbase there trying to make a move as well. Great stuff there. Thank you for that update, Jared Blickery there for us. All right, coming up, we're talking all things auto and Musk's foray into the advertising world with Optimind CEO Matt Foden. According to the Federal Reserve Bank of New York, auto loan balances increased by $10 billion to a total of $1.5 trillion in Q1. Now, that's a 6.26% rise year over year, with auto loan debts now comprising 9.16% of all household debt. Now, more borrowers are falling behind on their auto loans, returning serious delinquency rates to pre-pandemic levels, and it appears to be hitting younger borrowers harder than any other demographic. Now, there could be several factors contributing to these statistics: worsening auto loan underwriting, growing inflation, and rising interest rates as well. But the fact that more borrowers are missing their payments when economic conditions appear strong could lead to even more financial distress on a person level. Well, staying with cars, Tesla's Model Y is the world's best-selling car, beating out Toyota's RAV4 and its Corolla models. And this marks the first time an all-electric vehicle is the best-selling car across the globe. Joining us now is Yahoo Finance's Pras Subramanian to break this down for us. Quite a move here for Tesla.
Yeah, if you want to sell a lot of product, cutting prices usually is the way to do it, and that's what happened here with Tesla. As you said just now, Tesla crossing that top global selling car, according to Jayco Research and Motor1.com. You've seen that Tesla Model Y sold 267,000 units in Q1, just above that Toyota Corolla, which sells globally at 256,000 there for the top two. Drilling down into those numbers, you see that 35% of all Model Ys are actually sold in China. That's up 26% year over year. And 31% of all Model Ys were sold in the US. That's up a whopping 68% year over year. Now, good news here, but like I said before, cutting costs does sort of hurt your margins. It's a concern for Tesla investors, seeing that gross margin numbers dip below 20%. CEO Elon Musk doesn't seem so worried about it. He wants to grow the install base. He wants to sell higher margin software products. So that's his goal there. But also want to note that don't feel too bad about Toyota here, because of the top 5 vehicles, 4 of them were Toyota vehicles, and they have a global footprint, like I mentioned, and they're able to sort of weather certain concerns or issues that pop around the globe, territory by territory, whereas Tesla is sort of levered to US, China, and Europe as its top 3 territories.
So with that in mind then, how long do you think Tesla can hold that spot, especially if perhaps prices start to change and they start to level off, whereas some of these, legacy companies and a Toyota sort of slow and steady and consistent with their pricing?
I think that it's, with Q1 in the books, it seems like a good trend. The trend is positive for Tesla. They're probably going to try to grow on that within, of course, China and in EU and the US. This quarter in Q2, you had the first full quarter with the EV tax credit in effect, so that should help U.S. sales. But like I mentioned before, at least Toyota can sell across multiple territories across the globe. Tesla hasn't done that yet. They're not super huge in Asia beyond China. They're trying to grow in places like Thailand, India, Indonesia. That's up next. So that's kind of the plan for Tesla. I surmise that Toyota will probably sell a lot more vehicles in the back half of the year. They can sell cheaper gas-powered cars, hybrids across the globe. Their mid-size pickup, the Toyota Hilux, is a huge seller for them beyond the Corolla and beyond the Camry. So they have a lot going on. I don't know if Tesla will actually win the overall 2023 global race here, but good start for them in Q1.
Indeed. Prasa Romanian there for us with that update. Well, Tesla appears to have dropped its first ever traditional commercial on its Tesla Asia Twitter page. In this 2-minute video, a mother gives a driver testimonial about why she loves her Tesla Model 3 and highlights the car's features. Now, this marks a shift in the company's branding, as Elon Musk has tweeted in the past that he, quote, hates advertising. Well, joining us now is Optimind CEO Matt Voda to discuss more about where Tesla's advertising could go. Thank you for joining us this morning. So first, I want to talk about this foray of Tesla then. Of course. I want to talk about this foray of Tesla now into the traditional advertising space and really the timing around it. What do you make of it?
You have to tip your hat to Tesla for getting this far without investing anything in advertising. So that's pretty remarkable in and of itself. But I think from a timing perspective, despite the news that you just had just before this about Tesla Model Y leading car sales and that success, they face a lot of pressure in the market. Most of the major manufacturers have a whole slate of EVs coming into the market over the next 12 months. And I think that they realize that they have a branding issue in the market, and they face some pretty significant competition coming quickly.
So then in terms of the elements that really, if you were advising Musk as to how he should approach Tesla advertising, given that he is very outspoken, he's very visible on Twitter as well, and it is hard to separate the man from the brand.
Yeah, and I think that's Tesla's main challenge, and it's extremely difficult to solve. How do you separate Tesla's brand from Musk personally? And so Tesla needs to build a brand that can stand on its own, that has its own value and place in the minds of consumers, and where consumers don't automatically think of Elon Musk. And as I said, that's an enormous challenge. But Tesla has to have its own brand value in the hearts and minds of consumers that is clearly separate from Elon Musk.
And obviously, this is a time when a lot of companies are pulling back on their ad spend or being more strategic, at least. For the clients that you advise, I mean, you advise some big clients here. I know JCPenney's on that list, among others. In terms of what they're trying to do to get more ROI with their marketing and their ad budgets, how strategic are they being? Where are they putting their money to work?
You know, I think successful brands are resisting the pressure to reduce their advertising budgets because they know that creates difficulty down the road. And it requires great analytics to stand up to the finance team to say, this is the return that we're getting from these investments. This is what it drives in terms of revenue for the business. And so that's the first objective. And I think that successful brands are able to resist that pressure because they have the intelligence to prove the value of the advertising. From there, it gets a little more complicated. Consumers' buying preferences and behaviors have shifted pretty significantly over the last 24 months. And so brands have had to become more creative, maybe more persistent in terms of how they reach consumers where they're making their purchase decisions. And so a lot of brands are maybe moving away from more traditional forms of advertising to more modern areas where consumers are using their mobile devices to consume content, maybe using streaming devices to consume, traditional TV. And so brands are adjusting and adapting the channels that they're using to reach consumers because the consumers have shifted themselves. But it's a challenge. It's a challenge.
Well, you have an interesting situation with Musk owning Twitter, and of course they're able to advertise on Twitter as well. How do you think advertisers are really going to view sort of how they feel about having their ads placed on Twitter, say next to a Tesla ad, when obviously there's a very different interest when it comes to the actual CEO of a company now also being able to push his own ads for his own products?
Well, I think that and we've seen a lot of news on this front. A lot of large brands have moved their advertising off of Twitter, not because they're worried about their ads showing next to Tesla. They're worried about their ads showing next to objectionable content, and they're worried about the safety of their brands, and that drove an exodus of advertisers off of the platform. And so, a car manufacturer like Toyota or Ford probably worries more about their brand reputation than having their ad, run alongside of a Tesla ad. I think they're less worried about that. I think that they believe in their products. They know that Tesla is going to be investing in advertising here over the next year. That's a possibility, but I don't think that that's the main concern they have about advertising on Twitter.
And Matt, just very quickly to follow up on that, when they did leave Twitter, where did a lot of these companies end up going then?
I think that they found other audiences in other social media platforms. So Facebook was a beneficiary of this exodus. Even platforms like Snap and TikTok have been beneficiaries. So, these brands want to reach younger consumers who may not have a TV in their home, maybe consuming news and content on their mobile devices. And so social media is the place to reach that type of consumer. And there are other social media platforms besides Twitter in the market. And so brands had an easy switch to make to other platforms.
I certainly have options. A big thank you for joining me this morning. Optimind CEO Matt Voda. Thanks so much.
Thank you.
All right, coming up, our box office roundup. We'll take a look at how movie theaters fared this holiday weekend. That's next. Memorial Day weekend saw several large box office draws competing for first place. The likes of Fast X and Guardians of the Galaxy Volume 3 ultimately lost out to Disney's live-action remake of The Little Mermaid, which saw a $117 million domestic opening. Here with us now is Yahoo Finance's Ali Kanal to tell us more about it. Hey, Ali.
Hi, Rochelle, and that's right. The live-action Disney Little Mermaid soaring to more than $117 million in that 4-day opening weekend estimate, according to Disney. Now, that's just shy of the $120 million forecast, but still a very strong start to the summer box office season. And we could see that number tick higher to around $119 million. We'll have to see when the final results trickle in there. But, you know, when we think about this movie, it's interesting because Disney poured a ton of money into the marketing for it, a $80 million marketing campaign that featured live performances, social media videos, viral TikTok trends, and I'm sure it didn't hurt that the chatter online about this film, whether good or bad, probably convinced people who are on the fence to go out and see this movie. Now, overall at the box office, year to date through Sunday, ticket sales have climbed to just over $3.3 billion. That's nearly 30% ahead of 2022 levels, according to ComScore. And the momentum, it's only going to pick up from here with major films like Mission Impossible, Indiana Jones, Oppenheimer, the new Barbie movie, all expected to make a giant splash, similar to The Little Mermaid, no pun intended. Of course, a big question for analysts is which film will be the film of the summer. Last year, that was clearly Top Gun Maverick. And this year, when I ask analysts, they're not really able to give me a firm answer there because there are just so many movies from the giant tentpoles to some of those buzzy newcomers as well that I think it's going to be a very competitive summer box office season.
We're definitely much more spoiled for choice this year than we were last year. I still am going to see Little Mermaid. I'm getting around to that. But my other big favorite that I've been just excited about ever since I knew it was coming was the Barbie movie. Talk about the expectations there.
Oh my gosh, well, this Barbie movie, I mean, so many people have talked about it. When the trailer dropped, it was going viral on Twitter. Now, it's interesting because we did receive a new note from Stifel, which estimated the movie could bring in $400 million at the box office. That's up from previous estimates of $325 million. In terms of that opening weekend number, studios are looking at around $31 million. So anything above that would be considered a huge win there. But overall, there seems to be a lot of upside potential, not just at the box office, but Stifel argued for Mattel, considering Barbie is one of the most cherished brands at the company. So I think that's definitely one to watch. I'm excited for it. No one really knows the plot, but we have some really big A-list names in there, and I think that always gets people excited.
True, and you know that hot pink merch, you're already seeing it everywhere, so I can't wait. Ali Kanal, thank you so much. All right, taking a look at Wayfair stock, soaring on news that JP Morgan added the online retailer to its analyst focus list, assigning the stock price target of $63. Now, this comes after the firm gave the company an overweight rating. The Boston-based retailer is anticipated to outgrow other online retailers in the space, given the industry's longer-term shift to online retailing and the company's advantage over the supply chain, enjoying some gains there and up year-to-date as well, more than 19%. Well, that does it for now. I'm Rochelle Akufo, but I'll be back with you at 11 a.m. Eastern tomorrow. See you then.